Ladies and gentlemen, Finance Deciphered here. If you want to understand the timeline of the coming financial restructuring, you must stop watching Federal Reserve press conferences. Monetary policy statements are theater. They can signal intentions without commitment. They can be walked back within weeks. They exist to be interpreted, debated, and ultimately ignored by market forces. They are the performance layer of global finance designed for public consumption. If you want to know the true intent of a major economic power, if you want to know whether they are preparing for systemic separation from the dollar system, you must track the movement of Treasury holdings. Sovereign debt positions are structural. They are massive. Unwinding $1 trillion exposure takes quarters, sometimes years, without triggering market dislocations. And when the world's second largest economy begins liquidating American government debt at a velocity that defies conventional portfolio management, they are not optimizing returns. They are executing a strategic divorce. We are going to conduct a forensic examination of the data released by the United States Treasury Department in the latest reporting cycle. The Treasury International Capital System, known as TIC data, is among the most critical yet overlooked data sets in international finance. Headlines focus on the top-line number. We are going to analyze the composition, the velocity, and the geographic redistribution. The evidence confirms a pattern that institutional analysts have been attempting to rationalize, minimize, or explain away for 18 consecutive months. China's official treasury holdings have contracted to $688 billion as of the most recent reporting period. To those unfamiliar with the scale of sovereign reserve management, $688 billion sounds substantial. It is. But within the historical context of US-China financial interdependence, this figure represents structural collapse. This is the lowest level of Chinese ownership of American government debt since May of 2009. 16 years of accumulated positions have been systematically dismantled. For perspective, at the peak of the economic integration period in 2013, Beijing held $1.32 trillion in US Treasuries. They were effectively the marginal buyer that allowed the United States government to run fiscal deficits without triggering yield spikes. The capital recycled Chinese trade surpluses back into American debt markets. The loop functioned seamlessly for 2 decades. That mechanism is broken. China has liquidated approximately 48% of their peak position, over $600 billion of exposure eliminated. But the aggregate reduction is only part of the signal. The market context of the sales is equally revealing. Throughout the latter half of 2024 and into 2025, the U.S. bond market experienced significant pressure. Interest rate volatility persisted. Bond prices, which move inversely to yields, were suppressed relative to historical norms. Any entity selling Treasury securities during this specific window was realizing losses on positions acquired at lower yields and higher prices. In institutional asset management, you do not liquidate a depreciated position at a realized loss unless one of 2 conditions exists. Either you face immediate liquidity requirements that force asset sales regardless of market conditions, or you have concluded that the asset itself represents unacceptable risk that will worsen over time. We know China does not face liquidity stress. Despite domestic property sector challenges, they continue generating substantial trade surpluses with global trading partners. Dollar inflows remain robust. Therefore, the only rational conclusion supported by the evidence is that the People's Bank of China has made a determination that United States Treasury securities no longer function as a reliable store of value. They have been reclassified from reserve asset to strategic vulnerability. This is the jurisdictional risk signal. We must examine this through the framework established in February 2022 when Russian Federation forces entered Ukraine. The United States Treasury, in coordination with European Union financial authorities, executed a capital control operation that fundamentally altered Beijing's risk assessment. Within 72 hours, approximately $300 billion of Russian central bank foreign exchange reserves held in Western financial institutions were immobilized. These were assets the Bank of Russia believed were secure, held in accounts in New York, London, and Frankfurt. They were frozen through administrative action. Chinese monetary authorities observed this operation and conducted a strategic reassessment. The conclusion was unavoidable. If geopolitical tensions escalate regarding Taiwan or maritime disputes in the South China Sea, intensify to the point of kinetic conflict, Chinese holdings of dollar-denominated debt instruments are not assets on their balance sheet. They are collateral vulnerable to immediate seizure by the U.S. Treasury Department. The $688 billion they currently hold represents potential total loss the moment economic sanctions are implemented. Consequently, they are methodically reducing exposure. They are accepting mark-to-market losses of 10 to 20% on current sales, rather than risking total confiscation in a crisis scenario. This is strategic liquidation. It represents the financial equivalent of severing operational dependencies before conflict. Typically, when a central bank reduces Treasury holdings, they execute the operation gradually to minimize market impact. Sales are distributed across multiple months in modest increments to avoid signaling distress or triggering speculative positioning against them. But the acceleration of Chinese liquidation, with reductions exceeding $12 billion in single reporting months, indicates a prioritization shift. Beijing appears less concerned with optimizing sale prices or maintaining market stability than with completing the exit before a window of opportunity closes. They want capital removed from U.S. legal jurisdiction immediately. This calculation has profound implications for American fiscal dynamics. For 2 decades, the U.S. government could sustain fiscal deficits averaging $1 to $2 trillion annually because there existed a price-insensitive buyer in Beijing. China recycled trade surpluses into Treasury purchases, regardless of yield levels, because they needed to prevent yuan appreciation that would harm export competitiveness. That structural bid has vanished. China has transitioned from the largest marginal buyer to the largest marginal seller. This creates a fundamental supply-demand imbalance in the Treasury market. If China is liquidating hundreds of billions, who is absorbing that supply? Who is funding the U.S. deficit now that the historical anchor buyer has left the market? As the data reveals, the burden is being redistributed to allied nations, specifically the United Kingdom and continental Europe, who are being compelled to utilize their own balance sheet capacity to stabilize American debt markets. When the second largest foreign holder of your sovereign obligations decides to dump several $100 billion of securities onto the secondary market, elementary economics dictates that prices should decline significantly. When supply overwhelms organic demand, prices fall. In fixed income markets, when bond prices fall, yields rise proportionally. If market mechanisms operated without intervention, the Chinese exit should have driven 10-year Treasury yields substantially higher than observed levels. This would trigger cascading effects across the American economy. Mortgage rates would spike. Corporate borrowing costs would increase. Regional banks holding long-duration securities would face additional unrealized losses. The interest expense on the national debt would become increasingly unsustainable. Yet yields have risen only moderately. The market has not collapsed. Why? Because as China exits, allied nations are being positioned to absorb the supply. We need to examine the counterparties in the TIC data with precision. While the line item for Chinese holdings declines toward $600 billion, other jurisdictions are experiencing unprecedented increases, specifically the United Kingdom and Belgium. The United Kingdom's Treasury holdings have expanded to record levels, surpassing $750 billion in recent reporting periods. This positions the UK as the second largest foreign creditor to the United States, roughly equivalent to China. Consider the economic fundamentals. The UK economy is approximately 1/6 the size of China's GDP. Britain does not generate trade surpluses. In fact, the UK runs a persistent current account deficit. So where is the United Kingdom sourcing $750 billion to purchase American government debt? They are not accumulating these positions through export earnings like China did during the 2000s. The most plausible explanation is leveraged acquisition or financial engineering through London financial institutions. The UK is effectively utilizing its sovereign balance sheet capacity to function as a shock absorber for Treasury market volatility. Then examine Belgium. Recent data shows Belgian holdings in the $320 to $370 billion range. The Belgian federal government does not suddenly have surplus capital. Belgium is the domicile of Euroclear, one of the world's primary international central securities depositories. When you observe Belgium accumulating U.S. debt in TIC data, it is rarely the Belgian Treasury. It is typically other central banks, sovereign wealth funds, or institutional custodians utilizing Euroclear's infrastructure to mask their positions. It creates opacity in beneficial ownership. The timing is unmistakable. The surge in UK and Belgian holdings occurring simultaneously with Chinese liquidation indicates coordinated absorption by Western alliance members. This is not free market allocation. Why would rational investors in London or Brussels aggressively accumulate U.S. Treasuries under current conditions? The United States is running $2 trillion deficits. Inflation remains above central bank targets. The currency is being used as a sanctions weapon with increasing frequency. Purchasing U.S. debt in this environment represents a risk trade, not a safe haven allocation. The fact that allied nations are expanding positions suggests geopolitical coordination. Washington is effectively communicating to alliance members that if they do not absorb Chinese supply, American debt markets will destabilize. If American debt markets destabilize, the global financial architecture faces systemic risk. Therefore, participation is not optional. This is financial burden sharing disguised as investment. The West is redirecting liquidity from domestic uses to absorb outflows from Beijing. But this approach contains a critical vulnerability: capacity constraints. China possessed virtually unlimited capacity to purchase debt because they were the manufacturing hub generating perpetual trade surpluses. Dollars earned from exports were recycled into treasuries automatically. The UK and European Union do not have equivalent capacity. They face their own fiscal pressures, aging demographics, and energy transition costs. By forcing them to absorb Treasury supply, the United States is draining liquidity from allied economies. It strengthens the core at the expense of the periphery. This creates fragility. If the UK economy encounters stress, similar to the liability-driven investment crisis in 2022, they may be forced to liquidate Treasury holdings to raise liquidity for domestic stabilization. If that occurs, the backup bid disappears. China recognizes this dynamic. They are executing a campaign of financial attrition. Every $1 billion of treasuries they liquidate forces the Western alliance to locate $1 billion of capital to purchase them. This diverts resources from productive economic activity, infrastructure investment, or industrial capacity toward the financing of American fiscal deficits. It is a weaponized liquidation designed to strain Western financial capacity before any kinetic conflict initiates. Furthermore, this transition fundamentally alters the character of the Treasury market. Historically, it was dominated by economic buyers. Nations like China, Saudi Arabia, and Japan purchased for commercial reasons, trade surplus recycling, and return optimization. Now it is increasingly a market of political buyers. The UK, Belgium, and Japan, who purchase for alliance maintenance and strategic necessity. Political buyers are inherently less stable than economic buyers. They will continue purchasing until domestic political pressures intensify, currencies weaken, or fiscal constraints bind. We are observing the transformation from a global reserve asset to an alliance reserve asset. The buyer base is contracting while issuance continues expanding. And while Western nations shuffle dollar-denominated liabilities among themselves, China is converting the proceeds into assets beyond U.S. legal reach, into the physical economy. When China sells a treasury bond, settlement occurs in U.S. dollars. The People's Bank of China receives dollar credits in custodial accounts. But China's objective is dollar exit, not dollar accumulation. Dollars are traceable, subject to sanctions, and vulnerable to inflation. China is exiting the dollar system to eliminate American financial leverage. So what are they doing with proceeds from this $700 billion liquidation? They are not holding cash. They are not purchasing euros or yen. They are conducting the most aggressive commodity accumulation operation in modern economic history. They are converting financial claims into physical reality. We need to track the actual flows. While Western analysts monitor bond yields and equity indices, Chinese state entities are absorbing record volumes of strategic materials. This is not commercial inventory management. This is strategic stockpiling for autarky. First, the monetary metal pivot. As documented in previous analysis, the People's Bank of China has purchased gold continuously for 18 consecutive months, according to official reporting. Unofficial data from Shanghai Gold Exchange withdrawals suggests actual accumulation significantly exceeds reported figures. They are utilizing dollars from Treasury liquidation to purchase physical gold in London and Zurich markets, then shipping east. Gold represents the ultimate counter-dollar asset. It has no counterparty risk. It cannot be frozen through the SWIFT system or blocked by financial sanctions. By exchanging Treasury securities for bullion, China is transitioning from credit-based reserves to collateral-based reserves. Second, the energy security imperative. Crude oil. China imports approximately 70% of its petroleum consumption. This is a critical vulnerability. In any conflict scenario involving naval operations, the United States Pacific Fleet could interdict tanker traffic through the Strait of Malacca, effectively severing Chinese energy supply. To mitigate this risk, China has been purchasing record volumes of crude, often from sanctioned suppliers like Iran and Russia, settling in currencies other than dollars. Critically, they are filling strategic petroleum reserve capacity to maximum levels. Recent analysis indicates Chinese crude stockpiles, combining commercial and strategic storage, approach 1.5 billion barrels. Satellite imagery confirms construction of massive new storage infrastructure and underground cavern facilities. They are building buffer capacity sufficient to sustain operations through an extended maritime blockade scenario, potentially measured in years rather than months. The capital funding this petroleum accumulation derives from Treasury liquidation. Third, the Industrial Metal Foundation, copper and critical minerals. This is perhaps the most telling indicator. China's property development sector, historically the largest consumer of copper for electrical systems and plumbing, remains in severe contraction. Real estate construction has declined substantially, yet China's imports of copper concentrate remain near all-time highs, with approximately 28 million tons imported in 2024. This contradicts basic economic logic. If you're not constructing buildings, why import record copper volumes? Because the demand base has shifted from civilian construction to strategic stockpiling and military-industrial production. Copper is essential for renewable energy infrastructure intended to reduce oil import dependency. Copper is required for ammunition production, drone manufacturing, and electric vehicle systems. China is positioning to control global supply of the physical inputs required for 21st century industrial and military capacity. They are also accumulating cobalt, lithium, nickel, and rare earth elements. While the United States financializes its economy, China is materializing its savings. Fourth, the food security buffer. China produces approximately 20% of global GDP, but controls only 7% of the world's arable land. This is a structural vulnerability. In response, China has accumulated extraordinary grain reserves. According to United States Department of Agriculture estimates, China holds approximately 60 to 70% of global corn and wheat inventories. They have sufficient stockpiled grain to feed their population for over 12 months without any imports. They are trading the yield on financial instruments for caloric security. This represents a fundamental shift in strategic thinking. A nation planning to remain at peace holds wealth in efficient, yield-generating financial assets like Treasury securities. It optimizes return on investment. A nation preparing for potential conflict converts wealth into inefficient physical stockpiles that generate negative carry. Holding 500 million tons of copper yields no interest. In fact, it incurs storage costs, negative financial return. But it provides massive return on strategic security. China is willingly accepting lower financial returns today to ensure they cannot be economically strangled tomorrow. This explains their willingness to realize losses on treasury sales. Western financial analysts mock this. They sold at the bottom, they took losses. This reflects short-term thinking. Beijing does not concern itself with mark-to-market losses measured in fiat currency units. They concern themselves with resource security measured in strategic autonomy. If they sell a bond at a 20% loss but use proceeds to acquire oil that will be critical if Malacca is interdicted, that represents a successful trade. They are exchanging notional wealth that can be frozen or inflated away for tangible wealth that can be consumed, deployed, or weaponized. The Treasury liquidation is the funding mechanism for this strategic stockpile. They are using proceeds from the old financial system to construct infrastructure for operating outside that system. We have analyzed the flow. The data is conclusive. The trend is unmistakable. China is liquidating. Allied nations are absorbing supply with borrowed capacity. Proceeds are flowing into hard assets that function independently of dollar jurisdiction. The implications are clear for anyone holding long-duration U.S. government debt. The United States Treasury bond has been transformed into a geopolitical instrument. For 4 decades, the 60-40 portfolio allocation, 60% equities, 40% bonds, represented the standard diversification model. Bonds functioned as the stability component, the volatility buffer. That framework is obsolete. The U.S. Treasury bond is no longer a risk-free asset in the traditional sense. It is a political instrument in an economic conflict. It is an asset class dependent on the continued participation of nations with diverging strategic interests. If China, which possesses the deepest understanding of global manufacturing and trade flows, is systematically exiting, you must ask yourself a fundamental question. What information do you possess that they do not? So how do you position capital for an environment where the largest historical buyer has become the largest seller? You implement the Finance Deciphered Protocol. Protocol Directive 1, reduce duration exposure. If you hold fixed income positions, you must understand duration risk mechanics. Duration measures bond price sensitivity to interest rate changes. Long-dated securities, 20 or 30-year treasuries, have high duration. A 1% increase in yields can generate 20% price declines in these instruments. As China exits, structural pressure on long-term yields is upward. Even if the Federal Reserve reduces short-term policy rates, the long end of the curve, determined by supply and demand rather than central bank operations, remains vulnerable to buyer strikes. If Chinese liquidation continues and Allied absorption capacity weakens, yields must rise to clear the market. Rising yields mean declining prices for existing holders. Therefore, avoid long-duration U.S. government securities. Exchange-traded funds like TLT represent maximum vulnerability to this dynamic. If you require safety and liquidity, maintain positions in short-term treasury bills, 1 to 6 month maturities. Short-term bills have minimal duration risk. They are less sensitive to long-term geopolitical repositioning. They function as cash equivalents while providing modest yield. Follow China's approach, maintain liquidity, stay short-term. Do not lock capital into 30-year obligations with a government engaged in financial conflict. Protocol Directive 2. Follow institutional flows into real assets. China is liquidating paper claims to acquire physical goods. Consider implementing similar positioning. Your portfolio requires exposure to commodities, energy, and tangible assets. This is not purely return optimization. It is inflation protection and systemic hedge. Consider the endgame scenario. If China liquidates $688 billion and allied buyers eventually exhaust capacity, who becomes the marginal purchaser? The Federal Reserve. The central bank will be forced to function as buyer of last resort, implementing yield curve control. They will be required to create trillions of dollars to monetize debt issuance. When they create trillions of dollars, currency value declines and commodity prices rise proportionally. This is the inflationary mechanism. China understands this. That is why they are acquiring commodities. You should own the producers of these assets. If China is accumulating copper, own companies that extract copper. Freeport, McMoran, Southern Copper. If China is stockpiling petroleum, own energy producers, ExxonMobil, Chevron, ConocoPhillips. If China is acquiring gold, own the metal directly or mining operations. These assets provide protection against currency debasement. You want exposure to the commodities, not merely the currency used to purchase them. Protocol Directive 3. Monitor allied nation stability indicators. You need advance warning signals. You need to identify when the burden-sharing arrangement begins fragmenting. Monitor currencies of key U.S. allies, specifically British pound sterling and Japanese yen. These nations are straining their financial capacity to support dollar bond markets. Japan, in particular, holds the largest foreign treasury position. But Japan is simultaneously managing currency volatility. The yen has experienced significant fluctuations. If Japan must intervene to stabilize their currency, they will need to sell treasuries to acquire yen in foreign exchange markets. If Japan transitions from buyer to seller alongside China, the treasury market faces crisis. Watch the dollar-yen exchange rate. If the yen weakens toward 160 or 170, or if Japanese government bond yields spike, it signals the burden-sharing system is approaching failure. That is the moment Federal Reserve intervention becomes inevitable. That is when the policy pivot occurs. Not because inflation has been controlled, but because the treasury market is breaking. The $688 billion figure is not merely a statistic in a government data set. It is a countdown mechanism. China is systematically, methodically removing itself from the dollar financial architecture. They are preparing for strategic separation. They are willing to accept financial losses today to ensure operational independence tomorrow. Do not interpret current market stability as structural safety. It is artificial stability maintained through political coordination and leveraged allied purchasing. When that support structure fails, the adjustment will be rapid and severe. Exit long-term debt exposure. Establish positions in hard assets. Monitor the flow data. The divorce proceedings are complete. We are simply waiting for the asset division to finalize. This is Finance Deciphered. The protocol is active. That's T. Don't see it yet.